Inflation and interest rates explained. Inflation impact rate cuts truth. This is a message for anyone who feels confused, frustrated, or anxious about money, prices, savings, debt, and the future, because inflation and interest rates quietly shape your life even when you are not watching markets or reading headlines. And in 2026, this influence is stronger than most people realize. The story always begins the same way. You walk into a store and notice that the same items cost more. Your rent feels heavier. Your groceries stretch your budget. Your savings do not seem to grow as fast as prices. And you start asking a dangerous question. Why am I working just as hard but feeling poorer? This is inflation. Inflation is not just higher prices. It is the silent erosion of purchasing power. It is what happens when money buys less than it used to. And in 2026, inflation is no longer a temporary issue. It has become a structural force driven by supply chain reshaping, energy transitions, demographic changes, and government spending across major economies. Imagine money as water in a glass. Inflation slowly pokes holes in that glass. You may not see the holes immediately, but over time, the water level drops. That is what inflation does to cash savings. If inflation runs at 4% and your money earns 2%, you are losing 2% of purchasing power every year, even though your bank balance looks higher. This is why inflation feels unfair. It punishes savers quietly and rewards borrowers indirectly. Inflation impacts different people differently. If you live paycheck to paycheck, inflation feels like suffocation. If you are middle class, inflation feels like stagnation. If you are wealthy, inflation can be managed or even exploited through assets. This is why understanding interest rates matters, because interest rates are the primary tool used to control inflation. Interest rates are the price of money. When rates are low, borrowing is cheap, people spend more. Businesses invest more. Asset prices rise. When rates are high, borrowing becomes expensive. Spending slows. Businesses pause. Inflation cools. In theory, it sounds simple, but in reality, it is deeply emotional and political. Central banks raise rates to fight inflation, but every rate increase has consequences. Higher rates increase mortgage payments. Credit card debt becomes heavier. Car loans become more expensive. Small businesses struggle. Consumers pull back, and markets react violently. In 2026, interest rates remain one of the most powerful levers in the global economy. But many people misunderstand what rate cuts actually mean. There is a common belief that rate cuts are always good news. This belief is incomplete and often dangerous. Rate cuts do not happen in a vacuum. They usually happen because something is breaking. When central banks cut rates, it often means economic growth is slowing, unemployment risks are rising, or financial stress is building. Rate cuts are medicine. Not candy. Medicine helps, but it also signals illness. The truth about rate cuts is that timing matters. Early rate cuts during high inflation can reignite price pressure. Late rate cuts during economic weakness may not stimulate enough growth. In Arlil Central banks face a narrow path. They must balance inflation control with economic stability. The challenge is that inflation today is not only demand-driven, it is also supply-driven. Energy costs, labor shortages, geopolitical fragmentation, and climate-related disruptions all push prices higher. Interest rates cannot fix supply shortages, they can only reduce demand. This is why inflation in 2026 feels stubborn even after aggressive rate hikes. Now consider how this affects you personally. If interest rates stay high, savings accounts may finally offer visible returns, but debt becomes heavier. Mortgages feel painful. Businesses slow hiring. Investments become volatile. If rates are cut too quickly, inflation may rise again, erasing purchasing power. If rates stay high for too long, economies risk stagnation. This tension creates uncertainty, and uncertainty shapes behavior. People delay big purchases. Companies delay expansion. Investors seek safety. Understanding this cycle gives you power because Most people react emotionally to inflation and rates. They panic buy at peaks, they freeze at bottoms, they follow headlines instead of logic. A smarter approach begins with recognizing that inflation is not a short-term enemy, it is a long-term reality. Throughout history, inflation has existed in different forms. What changes is how prepared people are, those who understand inflation. Position themselves differently. They focus on skills that increase income flexibility. They reduce high interest debt. They avoid holding excessive idle cash. They think in real terms, not nominal numbers. Real returns matter more than headline numbers. If your investment grows 5%, but inflation is 4%, your real gain is 1%. This mindset shift is crucial in 2026. Many governments continue running large deficits, which increases the supply of money and debt. Central banks attempt to manage this through interest rates, but political pressure remains. This creates a world where inflation may come in waves rather than disappear completely for households. This means budgeting must be dynamic. Fixed assumptions no longer work for investors. It means diversification matters more than ever. Assets respond differently to inflation. Stocks can outperform inflation over time, but suffer volatility. Bonds lose value when rates rise. Real assets may protect purchasing power, but carry liquidity risk. Cash provides flexibility, but loses value quietly. The goal is balance, not prediction. Now, let us address the emotional side. Inflation creates stress because it attacks stability. When prices rise unpredictably, people feel out of control. This stress leads to poor decisions, such as overborrowing, chasing risky investments, or hoarding cash. Understanding interest rates helps restore clarity. When rates rise, it is not punishment, it is an attempt to slow overheating. When rates fall, it is not generosity, it is an attempt to prevent contraction. The system is reactive, not personal. In 2026, new data shows consumers are more rate sensitive than before. Small changes in interest costs now lead to larger changes in spending behavior. This means central banks must move carefully because the margin for error is thin. A small mistake can ripple through housing, labor markets, and financial systems. For you, this means awareness matters more than ever. Do not ignore inflation. Do not blindly celebrate rate cuts. Do not fear rate hikes without context. Ask one question: how does this environment change incentives? Then align your behavior accordingly. Inflation rewards preparation and punishes complacency. Interest rates reward patience and discipline. Over time, the people who survive inflation are not the ones who predict perfectly. They are the ones who adapt calmly. They understand that money is a tool, not a measure of worth. They focus on resilience, not headlines. In 2026, the truth is simple. Inflation is still reshaping daily life. Interest rates remain the main control lever. Rate cuts are not miracles, they are signals. The real advantage belongs to those who listen, think, and act with clarity rather than fear. Please subscribe for more updates and have a nice day. Thank you.